Okay, recording this video on Saturday, the 7th of March, 2020. It's just gone 1:30 p.m. Chicago time. Hope you are doing well. Hope you had a fantastic week's trading. Want to talk about the big picture. Is this the end of the correction or the beginning of the crash? And I'm going to look at some charts of bonds versus equities and show you what I'm seeing on my charts. But first of all, just to review this chart, I do this one kind of occasionally. It's the daily range for the E-mini, top to bottom, number of points kind of traveled. And below the price bars here, you can see what the ranges are. You know, this week we went over 150 points top to bottom on a couple of days, and goes back to 2017. And what you can see is we've been incredibly fortunate in the last 3 or 4 years that we've had these periods of huge ranges during the day for day traders, and it's just manna from heaven for a day trader. Just the amount of money that you can potentially make being correctly positioned directionally on these big days is unbelievable. And so I would just say make hay while the sun shines, because we go from these periods of extreme range to ones of really small range, and small range days are tough days. The big range days are all in blue here, and the small range days are in yellow. So yeah, just unbelievable activity at the moment and shows no signs of slowing down. Anyway, so let's talk about bonds. First chart I'm going to show you is the rates chart. So this is the 3 major kind of time periods. We got the 5-year, the 10-year, and the 30-year here. And these particular symbols, FBX.X, TNX.X, and TYX.X, gives you the interest rates of the 5, 10-year, 30-year bonds and notes. And we're down on the 5-year now here at 55 basis points. 10-year we're down at 70 basis points, and 30-year we're down here at 120 basis points. A couple of things to note. First of all, I talk about pullback and end of trend signals. They do not necessarily mean reversal. What they mean is the end of the trend, from which we'll go into a consolidation period, and then the trend move will come out of that. And you can see with each of these charts, this last move down into kind of October, November last year, pull back to end of trends on the lowest time frame, pull back to end of trend on the intermediate time frame. Exactly the same kind of picture on all 3 charts. And what it meant was it was the end of that move, from which we went into a consolidation period. And then we didn't change trend and go in the opposite direction. We reasserted the trend in that original direction. But pull back to end of trends, all that means is the trending energy is over. We're going to go through a cyclical pattern or a congestion pattern after that. And so you can see now with the activity that we've had, we're through 2 supports on these time frames here. The low and the intermediate has both been broken on all of these time frames, which means the trend isn't over until we see pullback to end of trend on the lowest and the intermediate time frame. But we're well past those kind of breakdown levels, and we're into kind of extreme territory here. And you can see that in the bond charts themselves. So this is the 30-year bond at US daily chart. Left and right kind of position here. This is the standard setup for my charts. On the right hand side we have the price-based indicators, but based on beta sine wave. Beta sine wave is pulling out the cyclical energy in the price activity here with the plots below the price bars, and this shows you the cycles. And when they go parallel, that means they're in trend of the intermediate and the highest time frame. And we put those support and resistance lines on the price bars themselves, and we paint uptrends and strength in red, downtrends and weakness in white. And then on the left-hand side, everything to do with volume. So on the bottom here, we've got volume momentum, which is the buying and selling volume. And then we extract average trade size from the volume data and show professional activity, large average trade size with blue bars, and yellow bars are small average trade size and amateur activity. And then the combo trend indicator, which is putting together the price and the volume information as confirmed uptrends in red in the background, and then confirmed downtrends in grey. And when we get a period of black background here, a null kind of indication, it just means that there's no confirmed trend. We're just going through some kind of change or consolidation. And you can see here, this is the activity in the 30-year bonds over the last 2 weeks. It's just been an absolute explosion. All these professional blue bars happening at the highs, and we've got an extreme reading up here. And we've, as you'd expect, this is kind of the inverse picture of the interest rates. We've broken up above resistance on the lowest and the intermediate time frame, and this thing has gone kind of parabolic to the upside. And, you know, where are we in terms of this reading? It's a massive reading at 3.2 million. We've not seen anything like that for a long time. I always talk about, you know, we go from extreme periods of exhaustion sell to exhaustion buy. And, you know, the exhaustion sell was down here, 136, we kind of bottomed, and then we broke into this uptrend, and now we're going through this kind of explosive period where we're kind of, the professionals are dumping out. Whether this will continue even higher, I mean, I was just a little bit shocked looking at this chart on Friday by how far up it kind of moved. So, but don't be confused. This is, you know, the smart money is getting out at these levels, legging out. I mean, this is got to play out in terms of pullback to end of trend patterns here. Oops, and we've got to go see bearish divergence after this as well. But the smart money that was kind of getting in on these panics and on these panics is getting out on these panics, and I think that's what we've got ourselves into at the moment. And then you can look at the difference between what the bonds are doing and what the equities are doing. And so this is an indicator that's up on the website for free. Is the bond oscillator. This is the one I want to show you, this version of it, just on the daily chart. To compare to different price activity here on TradeStation, we have to pick the same kind of exchange. So we're using the ETFs, so SPY and TLT. So this is a long-term bond ETF versus the ETF for the S&P500, and we can look at the momentum difference between what the equities are doing and what the bonds are doing. Yeah, they're kind of both moving together, but you know, there are periods where they start to move apart, and that's what this bond oscillator shows. So periods where we're oversold in equities and overbought in bonds shows with extreme patterns kind of down here, and we paint these bars red. Likewise on the upside, when we're kind of overbought on equities and oversold on bonds, we show the overbought equities with white bars kind of up here, and you can choose the levels that you've got. I've got some, I mean, there used to be kind of fairly normal levels that would just pull out this information at these kind of highs here, but what we've gone through with this move here, I don't think we've ever seen a reading like this where the differential between equities and bonds is so extreme. So the bond market has just been, the panic to safety here has just blown this thing out to a valuation that we've never seen. So we've got these kind of extreme readings in terms of oversold equities. So question is that going to continue? Are we going to, the equity is going to lurch down even further and the bond market's going to keep on going up? We're certainly reaching extreme levels in terms of oversold on equities and overbought on bonds. It's causing a reaction as well internationally. Again, I put this chart up. This is all my Forex charts all in one, so I can see what's going on. It's messy on a small screen, on a small little recording like this, but on the big screen you can perfectly see what's kind of going on. We've got the dollar index and Japanese yen over here. Bitcoin as well I put on. Then we've got the European currencies. We've got the euro, British pound, Swiss franc, and then the growth kind of emerging markets, commodity-based economies, Aussie dollar, Canadian dollar, Mexican peso. The story I want to show you here is the absolute collapse that we've seen in the dollar index over the last 2 weeks, and all of that money has been flowing into carry trade currencies with the reversal margin calls kind of happening there. So that's Japanese yen and the euro. And then move to safety with the Swiss franc, to some extent Bitcoin, kind of going on there. And then the currencies that are doing poorly are the ones that are both based on kind of global growth and commodity prices. So we got the Aussie dollar, Canadian dollar, and Mexican peso. Finally, the Mexican peso kind of gave way here. We've had big downtrends in these other currencies, and the Mexican peso was kept on being stronger and stronger. The point I want to show on this chart is, the flight to, it's repatriation of funds. This isn't flight to safety, because I wouldn't call, European bonds a safe place to run to. But this is margin calls happening. So we talked about this a month ago in a video talking about the money with negative interest rates in the Eurozone and Japan, the money in those economies, the free capital that can be moved around to be invested around the world, has moved into US, and then moved into US bonds, moved into US corporate and junk bonds, and it moved into equities to some extent. And now that we've got problems happening, we've got margin calls happening back in Japan and the Eurozone, and the money's kind of being flooded back. And that's almost like a positive feedback loop, because if you imagine you're in Eurozone, you want to get away from the negative interest rates there, you put your capital to invest in the US, and while the euro currency is going down, you're getting both the positive yield in the US, you're getting some capital appreciation in the US, and you're getting the appreciation in the US currency. All three things are going for you. But as soon as those three things start to reverse, you got the yields going down, the prices going down, and the currency reverses, you get a positive feedback loop where you have to pull the money back into euros, because you're losing on all three counts. And that money flowing back into the euro zone is causing the euro to appreciate even more, which is putting even more pressure onto those assets that remain in the US. So it's kind of a positive feedback loop that is, I don't want to say out of control, but we've had massive moves in these currencies. So that's the euro currency and the Japanese yen kind of going that way. British pound's getting a little bit of a kick to the upside, but it's not really involved in that game. It's the eurozone and the Japanese economy because of those negative interest rates happening there. The kick in the Swiss franc is because people in eurozone are scared stupid and putting their money in Swiss francs. Anyway, so that's what's happening in the currencies, and we talked about that kind of situation a month or two ago. And here's where the money is flowing back to currencies in those countries and zones. So here we've got the major bond markets broken into the US bond markets and the overseas bond markets, particularly the European and the Japanese bond markets. So this is government bonds and then high yield junk bonds in the US. And then here we've got government bonds. This is iGov, which is an ETF that follows the Eurozone and Japanese government bonds, and HYXU, which is the junk bond market in the Eurozone and the Japanese economy. So these ETFs are useful for, they cover a little bit more than just the Eurozone and Japanese economy, but they're heavily weighted there. So it gives you a good indication of where that money is flowing. And you can see here, this iGov has actually absolutely taken off. So we've got a flight to safety in the US happening with buying of government bonds, but that money being repatriated back to the Eurozone and back to Japan is buying government bonds in those areas as well. So that's why iGov is going up. The weak ones, finally these things have weakened, is the junk bond market in both of those kind of regions is starting to weaken. So we have got ourselves a full-fledged panic kind of going on here. The money flowing into bonds, out of the US dollar, into Japanese yen, into the Eurozone. We've certainly reached extreme levels at the moment. The question is this going to continue? So, we've got ourselves a correction, which is over a 10% reduction in the equities market. A crash is a 20% or more move down in the equities market. So the question is it going to be a stay at a correction, or is it going to move to a crash? So definitely we had a bounce on Friday, no doubt about that. Last hour or two of trade in the E-mini, we got saved at 2,900 here. This is an E-mini chart, the 15-minute chart here. So the market collapsed from the highs up here at 3,400 went below 2,900, and we've had a bounce this week, first couple of days. I said we would after Friday's activity with last week's video because, or was it Monday's activity? We had a bounce on Friday and a continuation of that bounce on Monday. And I said the amateur money would flow in on Tuesday morning because they thought that was it. That was kind of all over, and that's exactly what we had. So we had kind of moved back in by the amateurs on the Tuesday morning and then took profits by professionals, and then the move back up was weak. So you can see amateur up bars, so that's weak into that rally, and we've just kind of weakened kind of ever since. On the 15-minute chart, the thing that I'm looking for is exhaustion sell. We've had all these exhaustion buy patterns up here, and you can see here better momentum up here. Typically what you see is you see a mirror, symmetry between all the exhaustion buying volume goes into exhaustion selling volume. It goes on the downside, and the readings, have been pretty decent on the downside, but they've not mirrored the exhaustion buying that we've had here. So we've not had exhaustion sell signals kind of going on. We've got a cyclical cross happening on the 15-minute chart on the highest time frame. That's a pullback in a downtrend that's gone off here. So I would expect the energy on the 15-minute chart to kind of continue to the downside. What we need is a break through the 2,900 level in order to plumb to new lows to get that exhaustion sell kind of signal to really, clear out all of the panic sellers at that point. And I don't know, we've just not seen it yet. I mean, this rally was pretty strong on Friday, and they could force us back in and sucker more people in based on people thinking again 2,900, the bottom's in. But until we see that exhaustion sell on the downside, for me the probabilities say that is the most likely outcome, is that this thing is not over until we see exhaustion selling on the downside. So kind of wait and see. 45-minute chart, similar type picture here. So yes, a whole bunch of blue professional bars came in at 2,900. We've got cyclical support on this 45-minute chart in the highest time frame, but we're still showing weakness, and we've still got to make that pullback to end of trend on the intermediate time frame on the 45-minute chart. Same thing, exhaustion buy here with Rambo patterns, or say exhaustion patterns with Rambo is unstable, too many amateurs buying at that high. But we've not seen exhaustion sell to counter it on the downside, so doesn't look right to me quite yet. And the 135-minute chart, again, blue professional bars all the way down, selling it down here, picking it up down here, but again, those are the exhaustion buying patterns going on here. It was pretty decent read on the downside, but it doesn't mirror the levels that we had exhaustion buy. And on the 135-minute chart here, we're in a downtrend. We need to break below this 2850 kind of level here to take us into a downtrend on that intermediate time frame, which we bounced off temporarily. So that 2,900 level is absolutely key, 2850 kind of there. If we crack through that, I think on the downside we'll get those exhaustion patterns. But so far, they're holding. We had a little bit of bounce on Friday. Let's see if that kind of turns into anything. The question is, we're going to have another lurch down in equities, and well, I'm constantly looking every day at this 15-minute chart and just to see, what this is likely showing us. Let's see Sunday's open into Monday and see what actually happens, and whether we get another kind of move down to flush out even more people below 2,900. Anyway, hope your trading goes well next week.